Consumer inflation refers to the disorderly and prolonged increase of prices of goods and services that represent the consumption of households. When inflation is high, people can buy less with the same amount of money. Investors use inflation as a benchmark to ensure that the purchase power of their wealth does not erode. In turn, they will seek investments with an expected rate of return that is higher than inflation. But be careful, as the inflation print provided by national agencies is just an approximation of the rise of prices in an economy. Each individual has its own consumption habits and therefore a different personal inflation. In today's world of low interest rates and rising inflation, investors need to be mindful that many fixed income instruments might not offer returns above inflation. As such, many will have to include riskier assets in their portfolios to meet their required returns. Structured products, private equity, and hedge funds can be suitable for investors holding excess cash in their portfolios.